Right, I've put this off long enough. It's time for me to learn about investing.
It's really covered just about any investment that you could think of. Like, for instance,
Seen in crude oil. So, demand
environmental and social issues into the way they do business, into their business model, and into their
So, if you're feeling like this about investing, in this video I'm going to give you the absolute basic building blocks to get you started into this whole world and get you feeling like this. So if that sounds interesting, let's dive in. Why invest? Like, what is the point of it? Now, I talked a lot about this point in the previous video, linked somewhere around here. You can watch my thorough case in that. But very quickly, let me give you a brief. The biggest case for investing is nothing but inflation. I mean, banks nowadays pay literally nothing, next to nothing in terms of interest rates. And inflation is on the rise. Inflation is basically the rising of prices. You know, a chocolate bar costing £1 today is going to cost you maybe £3 tomorrow in a year's time. So if your money isn't growing at the same rate as these, you know, prices growing up. So let's say if the inflation is like 2% every year, which is sort of the average of what in the UK currently is. If your money isn't growing at 2%, and which it isn't, because if you're just putting it at the banks, I mean, banks give interest rates of like next to nothing. If you get 1%, you're probably like SSG God level. Let's say you do though, let's say somehow, somewhere this bank, God level bank pays you 1%. If inflation's at 2% and your money is growing at 1% every year, that's a net loss of 1% every single year. So your money in actual terms is losing value. The power of it is decreasing by 1% every single year. You want your money to be at least growing at the rate of inflation, if not even better, like more than that. Now, there are other factors, obviously, that why you should invest and why you shouldn't, and all that kind of stuff. Now, you can watch that in my previous video, as I said before, linked somewhere around my face somewhere. I always forget which side it is, but you can always go check that video out if you're interested. But what actually is investing? Now, I'm a millennial, right? So the only thing to do is go on Google. So let's see what Google says. What is investing? According to Google Baba, investing is putting money into financial schemes.
हीरो की स्कीम मेरे हाथ लगी है 25 दिन में पैसा डबल
Shares, property, or a commercial venture with the expectation of achieving a profit. Yeah, that pretty much sums it up. I love giving examples because I think it's the best way to sort of explain something. Let's say you buy a property because your parents say it's good. Buy property, okay. Now, there are two ways this property or asset most likely is going to profit you. Number one is going to be income, and number two is going to be capital growth. Now, let's take this one at a time. Income is basically, let's say you buy this property as an investment. So you buy this and you rent it out to someone for, let's say, £800 per month or something. And after paying your mortgage on that property and your management fees for the estate agent and all that kind of stuff, you're left every single month with about £200. And that £200 is the profit that this, or income, this asset is generating for you, or a more technical word is cash flowing for you. Now, that's the income side of it. The second part is the capital appreciation. On average, house prices have grown in the long term in most developed countries, and in fact in the UK in the last 10 years house prices have gone up nearly 50%. Now, let's say this property that you have, you bought it for £100,000, and after 10 years value of that property is £200,000. That £100,000 is your capital appreciation, and that is pretty much the capital growth of this property or an asset. So this model of income and growth, capital growth, is something that most asset classes out there follow, and that sort of neatly brings us into the different types of asset classes out there, or different investments out there for you to invest. So we could literally be sitting here for days talking about the different asset classes. You know, there's options, futures, equities, bonds, forex, gold. Oh, the list is endless. But I'm going to be focusing on to the bread and butter of the investment class out there. There are two main investments I should really know about: shares and bonds. Now, let's talk about shares first. So shares, or equity as it's known, a share is just ownership or part ownership of a company. So let's say I start up a company called Anirban LLC, and eventually I grow it, and then eventually I want to take it public. You know, you've heard about IPOs, like Coinbase has gone through its recent IPOs. That's basically a public offering. I issue 10 shares at £100 each, and you come along as an investor, be like, look, take my money. Okay, I want to invest in your company. And you pay down £100 and you take one share of my company. So effectively what now happens is that you are a 10% owner in my company. And now every time my company makes any profits, so let's say in this financial year, my company's made £100 profit, let's say, you are entitled to 10% of those profits, or £10 of those profits. And that is pretty much how the whole shares thing works. It's just nothing but just part ownership of a company. And yes, I have grossly oversimplified of how public offerings work, but that's not the point of this video. The point is just to get across what a share or equity actually is. Number 2 was bonds. Now, bonds are nothing but just loans that you give to certain entities. Now, the type of bond it is depends on the entity you give it. You have corporate bonds that you're basically loaning money to corporates, so like, companies basically. Or you have government bonds where you're just loaning the money to the government. Bonds can be just bought on the public market, like how shares can be bought. And how they work is that you loan your money, you lend your money to the government for a set period of time. And the government in return issues you something called a coupon, which is basically the interest the government is going to pay to you for, lending them the money. And at the end of the initial contract of the bond itself, your bond matures and you get your initial investment, the initial money back from the government. And that's pretty much how the gist of how bonds work. The thing is, bonds are kind of complicated, and bonds are used a lot of the times to indicate how the economy is performing in general. It's complicated more slightly, I would say, compared to shares. I'm thinking of making a dedicated video about bonds, so if you're interested, keep an eye out for that. But yeah, that's sort of how the gist of how bonds sort of work. Now, there are other asset classes, like mutual funds, index funds, my favorite, and there's peer-to-peer lending, there's crowdfunding, there's loads of different investment avenues. You can invest in startups like angel investing and all that kind of stuff. But those things are way beyond the scope of this video. This is just for beginners, a basic broad overview. And to be honest, I don't know a lot about those specific investments as well. I'm still learning. As I said, as long as you know about these basic 2, shares and bonds, the rest sort of falls into place, I feel. Now, the question that everyone wants to know: will I lose all my money? To understand this, you need to understand 2 concepts. The first one is the concept of realized and unrealized loss. If you're investing into the markets or have invested in some capacity ever, you would have seen the market goes up and down every single day. Like, some days it's up, some days it's down. But the thing is, that is just unrealized loss. You haven't actually lost that money. It's just what the market is doing, fluctuating and doing its marketry. And the thing is, you only lose that money, so you only lose that $5 effectively if you sell out at that time. If you just let it be where it is, you haven't lost any money. So don't let it overwhelm you. The day-to-day fluctuations, it happens. Just think of it at a long projection. Just don't let that overwhelm you. The second aspect to this is sort of tied to the first one. Play the long-term game. If you're part of the day trading camp or the forex trading camp or whatever the new fad is nowadays, the risks go up exponentially. Okay, so let me give you an example of how this whole thing pans out. So let's say that you bought this Apple stock here 21st September, you bought this Apple stock. This is your first time investing. You've heard about the hype of Apple, the future growth. So you're like, let's go into Apple. You buy at 21st September 2018, you buy at $54 per share, $54.42 per share. And because this is your first time investing, you keep looking at your brokerage. You're like, oh my God, what's going on? You wake up every day, you're looking at it, and then you see this happening every single day. Your portfolio is decreasing until you get to this point. You're like, Jesus, I'm 23% down. You're like, no, I'm gonna pull the plug. Investing sucks. I'm gonna get out of this. This is not for me. Let's say if you just held on to that investment, just be like, okay, I'm not gonna look at my platform. Whatever happens, happens. I'm just gonna let it ride for the long term. So let's say again, you bought it out here somewhere. I don't know, I've lost the point now. But let's say you just bought it here in this peak over here, and you see keep it going down, but you don't care. You let it ride, and eventually it picks back up until we come to today, which is the 19th of, well, today is 20th, but it's the 19th. Whatever, that's yesterday. Your investment would have grown to 120% in value. Crazy. Mind blown. I don't think I have to say much more. And I think that pretty much sums it up. The best way to do this, the best way to invest, if you're going to put any money into this, just invest for the long term. Think of investing for the next 10 plus years. If you buy your investments doing proper research, and you buy quality investments, with proper research, proper due diligence, and you're not just riding on speculative hype trains, you're pretty much guaranteed the upside. The only thing you need to remember is just play the long term. That being said, however, I do follow some cardinal rules of myself that I set for myself for investing. Number 1 is always have an emergency fund. You know, this could be like 3 months or 6 months or whatever. I mean, the going thing I think is about 3 months of expenses saved in a liquid savings account. You don't want to invest this money. This money should be in a bog standard savings account. Number 2 is pay off any high interest debt. You know, credit cards, if you have any credit cards debt, they charge like 25-30% APR. So if you have any money that you want to invest, first pay off the high interest debt, because you get a better return for your money. Essentially, you get a 25-30% return on your money because you don't have to pay that interest anymore. You're not going to find that in the markets. And number 3 is, going back to my first point, play the long-term game. It's just simple as that. So hopefully I've sold you onto this idea of investing, and now you're thinking, dude, how do I do this? Where do I put my money? Do I just put it through my computers? Because that's not going to work, is it? The way you do it is you go invest your money through a brokerage platform. Every single country has their own brokerage platform. I think in the US you have M1 Finance, Robinhood, or Webull, I think is one of them as well. In the UK you have Hargreaves, you have Free Trade, you have this I heard about a new one called Stake. There's loads of them. All you have to do is go to Google Baba, type in brokerage platforms and whatever country you're in. So in the UK, in the US, in India, in Finland, wherever you live, just do that and you'll come up with a list of brokerage platforms. The only thing I would say is make sure that whatever brokerage you're using, make sure that either the commission is free, which would be brilliant, or if they do have commissions, make sure they're low. Just shop around, you know, be chindi, alright? Whichever one gives you either free or low, use that. Another thing to make sure is, and this is more important than the first one, is make sure that whatever brokerage you use is FSCS protected. Now, I think there's different versions of this in different countries. I think the US have some version of this as well. What the FSCS is, this is specific to the UK by the way, is that if, let's say, that brokerage goes down, goes bust or whatever, the government backs you for £80,000. Let's say you put in £100,000 into that brokerage account. If that brokerage goes bust tomorrow, £80,000 would be still guaranteed by the government and they'll pay you back. Boy, that was a lot of information, I know, and I hope you have soaked up somewhat of it, but hopefully I've done a decent job and given you a decent sort of grounding into the world of investing. So, here's to more investing knowledge of financial literacy, and hope you have gained some sort of value from this video. And if you have, don't forget to smash that like button because it makes the YouTube algorithm feel warm and fuzzy inside. And if you're new here, don't forget to subscribe so you can get more of the new videos that I'm gonna make in the future. Until then, as always, adios.